Welcome to RFI's Banking Uncovered, the podcast going behind the industry PR, the media spin, the product awards and the investor reports to look at what's really going on in the customer data and to ask global thought leaders about their thoughts and views on the future of banking and payments.
Welcome to this episode of RFI's Banking Uncovered, where I'm delighted to be talking to Rishi Lalwani, who is the current Global Head of Lending for SME Banking at Standard Chartered, based in Singapore. Rishi started his career over 20 years ago back in Mumbai. He's been working in business banking and for a large portion of that with a particular focus on digital transformation, and is now responsible for all 15 of Standard Chartered's SME markets, predominantly across Asia and the Middle East. So I'm really excited to talk to Rishi today about SMEs, digital, fast-growing Asian economies, emerging markets, and all things in this space. So welcome to the show, Rishi, and thank you very much for joining us.
Thank you so much, Charles. Thanks for having me.
Great. So let's start with a statistic that always fascinates me, because if you go right back to 2000, this was an issue then, and it feels like we're making slow progress as in the banking community with this, which is that 40% of SME owners would like to have a business card, but instead of using an appropriate business credit card, they use a standard retail credit card, and that hasn't really changed, that dichotomy between the amount of business owners who want to use a business card and the amount of business owners that actually use a business card for what feels like 20 years now. And now, obviously, is it a marketing issue? Is it an awareness issue? And more importantly, as we move further and further into the digital transformation of the entire payments space, do you think digital will finally help bridge that gap and make sure that everyone who wants to use a business credit card is actually using a business credit card rather than, for various reasons, still using a retail credit card?
Sure, that's a great question to start with, Charles. I think first let's understand what does a business credit card do in terms of solving the pain points and needs of an SME, right? So four things come to my mind. Number one, as by its very nature, it's a simple product. It's a simple documentary requirement to set up a credit limit, simple assessment. It's a pay-as-you-use kind of a product model, right? Number two, it's obviously coming with an interest-free period of 30 days, 55 days, better cash flow management for the SMEs. So why not? It definitely helps in terms of managing the working capital cycle better. Number three, it helps in terms of tracking day-to-day expenses, better record keeping, better categorization of transactions, etc. And number four, finally, any unexpected expenses, any unforeseen events, delays in vendor payments, delays in receivables, obviously a credit product is very handy. So clearly the need and the kind of service that a business credit card definitely does add merit to an SME. But let's also understand on the flip side the kind of challenges that some of the small businesses face when they're using a business credit card, right? Number one, small businesses, again, by their very nature, may not have the organizational capability and accountability to maintain and manage a business credit card, right? Typically, these kind of business credit cards are sublimited to various employees of the company. There are delegation authorities given, spend limits, etc. Managing those kind of delegations, making sure that the payments are happening regularly in time, the discipline around that definitely does take some level of organizational capability, which, let's face it, the small businesses may not get the time to do diligently and in a disciplined manner. Number two, the potential misuse of cards, right? So having unauthorized employees using the card, or for that matter, having an employee who's authorized but using the card for an unintended purpose. I think those are some of the governance and monitoring kind of challenges that would come across. And SMEs are in the business of their own day-to-day operations, so they may not have the time or bandwidth to kind of set up those controls in place. Number three, I think the biggest challenge is the difficulty in delineating personal expenses vis-a-vis business expenses, right? And there again comes in the nature of the entity. So if it's, let's say, an example, a simple promoter-led kind of a company, the promoter ends up buying a laptop and uses a business credit card for it. Who's to say whether the laptop is going to be used for personal use or business, or perhaps a combination of both? So the lines do get a little blurry when it comes to expense management for what is business versus personal. And lastly, of course, if the small businesses come in with a lack of rich credit history, a lack of collateral, they typically end up with credit limits which may not be the most meaningful or appropriate, which would mean that they anyway would scout in the market for more lending products. So I think long story short, put in all the challenges together. The biggest takeaway would be that there is definitely a pain point in having a simple credit product available, which can be availed in a fast manner. And as long as banks and financial institutions are able to identify that pain point and address that pain point, it could come in the form of business credit card. As you said, digital is clearly going to help that piece. Whether you want to create digital cards, digital sublimits, the monitoring around it, you can even ring fence end use to making sure that it's a B2B kind of card. So all of those things would definitely help. But there are banks and financial institutions who choose to go down the route of certain alternative credit products, such as, say, a working capital requirement, a short-term loan, an unsecured long-term loan, or even a business credit debit card for that matter. So yeah, as long as I said, the need is identified and addressed, that's, I think, a happy story for the SMEs at the end of the day.
Okay, I want to stay on the pain points of SME owners for a moment, or certainly their goals and banks' ability to help them meet their goals. So traditionally, when we ask SMEs across AP, across the Asia Pacific region, what their goal is for the next 12 months, it's normally to grow revenue, to open new markets, to improve profitability. This year in RFI's data, the number one goal for the next 12 months is to improve operational efficiency. And that's quite obviously requires different servicing to an SME that's looking simply to grow incredibly rapidly. And so as you think about how can we help our SME customers improve operational efficiency, and how can we potentially broaden the value proposition as bankers in order to bring in more things, particularly around integrating other types of useful software. How is that focus on operational efficiency as opposed to revenue growth going to impact the digital capabilities that bankers should be thinking about offering their SME customers over the next 12 months?
Sure. So I think if you look at the whole aspect around how SMEs would try to derive efficiency, as you said, that's a key priority for SMEs, and I couldn't agree more. I think with the economy also digitizing, various aspects of the economy are digitized in a manner that you can use them far more efficiently. So let's again start with the challenges that an SME would face in this objective of efficiency achievement, right? So number one is the kind of day-to-day operations that an SME sees. Typically, these are manual processes, legacy systems, sometimes an absence of systems as well, multiple platforms that SMEs are using to do their day-to-day business transactions. Number two, adopting digital technologies. While digital technologies are available, I think adopting them, making sure that the resistance in the employees that the SMEs have to adopt them and to use them, all of that to make sure that it's growing and their business expansion plans, etc., are taken care of with the help of those digital technologies. That remains a big challenge as well. Number three, fragmented data and lack of visibility of data to use that data to project future cash flows, financing needs, and timely repayments or payables. I think that continues to remain a challenge for a lot of the SMEs in my experience. Number four, finally, any emerging trends and themes when we talk about it, whether it is digitization, cybersecurity, sustainability, I think SMEs constantly feel the need for training and development, learning opportunities in some of these emerging themes and how they will help in efficiency driving. Now, if you look at an SME's banking needs, or from a banking perspective, what kind of challenges does an SME face in terms of achieving their goal of efficiency? Number one is access to finance, right? We spoke about access to finance being a pretty important space, and there's a massive financing gap across most markets, including Asia. So lack of credit history, the digital footprints not being there, that will typically lead to credit not being available to a lot of SMEs. Number two, sometimes with the kind of footprints that the SMEs have, it does encumber certain complex and document-intensive processes, right? To know the customer better in the absence of, say, audited financials, you'll start getting deeper into transactional history, especially if you don't have a relationship with the bank, etc. Number three, the speed to market. So one thing is clear that SMEs do need capital, and there is a massive gap, but SMEs need capital fast as well, right? It's important to address some of those working capital or supply chain kind of constraints, and speed to market becomes an extremely important part of their banking requirements. And number four, finally, a lot of the data, insights, and analytics that banks have, those can actually be used to facilitate timely products, services, and the right kind of advice to SMEs. So I think these would be some of the challenges SMEs would have or pose in front of their bankers or financial institution. Now, let's understand how banks and financial institutions are addressing these kind of challenges put up by the SMEs, right? So, three things to talk about. Number one, digital first solutions. Now, most of the banks and FIs have been benefiting from the digitization of the overall economy, whether it is the entire ecosystem around company registries providing digital information, tax portals, eKYC tools, open banking, OCR. There are multiple digital ecosystem providers to provide a lot of data that would enable digital onboarding, online banking for SMEs, for a lot of banks and financial institutions. Number two, the use of alternate data. So especially if you go down the rung of the smaller businesses, the informal sector of SMEs, they may not have 2 years audited financials. They may not have the kind of rich credit history that bankers would typically look at to assess credit worthiness. But therein comes in again aspects around digital data, whether it is GST, whether it is VAT, tax information, invoice information available, payments information, gross merchandise value information from e-commerce platforms, name it or not. I think the last decade or so, the biggest data boom, the biggest benefit for SMEs has been the availability of data through these various sources that I just named. Number three is embedding finance into day-to-day operations. I think a lot of the successful banking partnerships that we've seen over time across markets and across players, whether it is integrating into the accounting platforms that the SMEs are using or integrating into the e-commerce platforms and providing financing to SMEs on those platforms without having to go into a bank branch or, for that matter, a banking website or a mobile app to avail those products. I think that has been one of the biggest benefits digitization has brought about. And lastly, I think banks have started over the last few years thinking beyond core banking products. And that's where some of the training and development needs that I spoke about that SMEs may have. I named a few: digital transformation, sustainability, cybersecurity, various mediums in which banks are sort of addressing this kind of a need, whether it is in the form of webinars, e-learning modules, masterclasses, mentorship opportunities, grants, seed funding to kind of promote a lot of the entrepreneurs and young minds to kind of put up new age business models. I think those are all in the right direction to sort of make sure that this overall goal of making SMEs more efficient is reached out.
Okay, I want to come back to cybersecurity in a bit when we talk a bit more about cross-border, but just talking about digital first solutions. So obviously, in the last 10 years, particularly since 2015, if not in the last 15 years, really, certainly since the invention of the smartphone, we've seen a huge rise in not just digital capabilities, but digital demands from SMEs. And that's created space for fintechs to come in where they see customer friction. It's created the need for banks to up their game when it comes to their digital capabilities and solutions. And it's also, up until recently, caused a huge amount of movement in the market. So I think for the last 5 years until a year ago, about 1 in 3 SME customers, according to RFI data, were looking to switch their main banking relationship in the next 12 months. That's now fallen off to just 1 in 5, so a drop of 33% to 20% looking to switch, which is a huge step in the right direction for traditional banks. Now, given the fact that the number one reason for moving is digital innovation, given the digital demands and requirements which you've alluded to of SME customers, particularly in some of the faster growing and emerging economies, which are sort of digital first economies, are we seeing this reduction in switching intention? Is it because digital capabilities have become ubiquitous, so it doesn't matter if I go to a bank or which bank I go to, or if I go to fintech, that it's all pretty much likeness for likeness now? Or has the digital capabilities that financial institutions can offer, once it's put within the very good restrictions of regulation and reducing cybercrime, sort of reached a peak and plateaued? So it's harder now to be truly innovative without crossing regulatory lines. What do you think are the reasons for this this reduction in SMEs' desire to switch for digital, given it's their number one driver?
Thanks. It's a very pertinent question and a very pertinent theme in terms of digital capabilities and how products have evolved over time. And I think I'd cover three aspects around this. So I'd talk about products and how they've evolved over time, typical core banking products that we have learned to know. Number two, I'd talk about the new models, the kind of partnerships that we're seeing in this space in SME banking. And number three, I'll again touch upon beyond banking. Firstly, competition is healthy, right? In my mind, I think having the number of years of experience I've had in SME banking, it's a great time to be an SME banker because a lot of digital banks, neobanks, non-banks, conventional banks, of course, continue to be there. And competition being healthy and almost a pervasive digitization of all aspects of the economy across developing, emerging markets. I think the core banking product definition or the way we've known products to be has now fairly commoditized. I think when you talk about a checking account, a current account, a term loan, etc., almost all the players would have very, very similar products, if not the same. So the true value differentiation in my mind comes where the whole evolution around products has started to come in, right? So products are no longer standalone products. Products are about value propositions. Products are about how are you using, case in point, and an example that I would want to quote is how are you using some of the partnerships and new age models to make sure that SME needs are addressed through creating true value propositions for them as against a simple transactional product need being serviced. So two examples that speak about in the partnership space that I've seen, and multiple banks, multiple markets have kind of been there and done the examples that I'm talking about. Number one is, let's say, B2B marketplaces, right? Earlier, when we talked about a marketplace, you would talk about a buyer and a seller coming on a platform. They basically do a trade, and that's the end, and that's the objective of the B2B marketplace. B2B marketplaces have evolved significantly where there is a whole gamut of ecosystem players, whether it is financiers, bankers who are there for financing the trade, underlying trade, or you talk about logistics companies, warehousing companies, or you talk about digital payment providers. And all of these players don't work in silos. A lot of the data from some of these players can actually help banks and FIs to make more wiser credit decisions and give access to capital to companies trading on those B2B marketplaces. The second example would be on embedded finance, right? We touched upon it in terms of the accounting integrations, etc. Gone are the days when I think accounting platforms were used simply to integrate into a bank's core banking system and just help with a current account or a cash management solution for payrolls and vendor payments, etc. I think a lot of the banks have started realizing that in the absence of a lot of rich data around SMEs, especially again the lower rung, accounting data does become a rich source of data to basically provide credit, to provide financing. So it goes beyond the traditional products that, say, an SME would have integrated their accounting platform to a banking system too, and starts looking at more data-driven insights and appropriately servicing the right kind of products to SMEs. Lastly, I think the biggest differentiator in my mind, which is completely irreplaceable, is the kind of advice and insights that a relationship manager brings in. While the world is digitizing and banks and financial institutions are adopting those digital tools and trends as well, I think nothing replaces the advice that goes beyond a one-time transactional kind of a product experience. And that's where some of the talent that banks and financial institutions are investing in hiring the right kind of people, training the right kind of people, and making sure that the right kind of advice and insights are available to SMEs beyond those simple transactional product needs. I think those in my mind are definitely the biggest drivers of digital innovation and how these digital capabilities go beyond the standard commoditized product kind of an approach that banks were used to doing.
Okay, you talk about, the role of bankers as advisors and providing advice and relationship managers, and traditionally that has been delivered through the mechanism or the channel of a branch, which kind of brings us, to the elephant in the room when it comes to digital banking. Is like, what is the role of the branch going forward? Now, obviously, with the 15 markets you're across, you've got a very nice blend of slightly more established, fast-growing economies where there's a branch network in place, and you've also got some very fast-growing emerging economies which are digital first and where there isn't a branch network in place, and you can kind of leapfrog that form factor, so to speak. So as digital innovation increases, but whilst there is still this huge value add from relationship managers and traditional human advice as opposed to perhaps Gen AI advice, what do you see as the role of the branch, especially in these digital first economies that you're looking after? And how do you kind of see that playing out? What are some of the ways that the branch is gonna shift and change?
So this question, I think my response would be a little bit speculative because it's a fairly evolving space right now.
That's fine. We're just chatting.
Absolutely. Absolutely. So, I mean, digitization has touched so many aspects of the economy that it goes beyond banking and financing, right? And that's why I think you have to use a little bit of imagination to kind of think how would a future bank branch look like. So I think some of the previous requirements that we've known as bankers for a customer to walk into a bank branch, whether it is depositing a check, whether it is requesting for a passbook, an account statement, or simply just applying for a product. A lot of customers can basically do a lot of those kind of requirements online, whether it's through a mobile banking app or an internet banking portal, or for that matter, reaching out to their relationship manager, whether it's a virtual chatbot, a call, call centers are there. There are so many different mediums available for which clients don't need to step out and go into a bank branch to do what they were supposed to do, say 10 or 15 years back. Nonetheless, I think bank branches do continue to add a lot of value because they do address product needs that clients may have, which let's say there are client segments that are not the most digitally savvy, or for that matter, client segments who need a little bit of that upliftment help, who need a little bit of that financial inclusion. They don't have relationships with the bank. So it's important to kind of have that presence. And it obviously does add value to the brand and visibility of the financial institution banks, right? That said, I think and this is where the speculative part comes in. I think the bank branch of the future would be more or less a virtual or a digital presence, right? So it can offer a completely digital sort of an experience and yet at the same time make it hyper-personalized with the kind of data footprints that are available with the bank, both on us as well as off us. And this is a reality that we're seeing across the banking sector where multiple banks have sort of experimented applying the principles of meta into banking, right? I mean, think of it in a way that you have a 3D bank branch, and instead of walking into a physical bank branch, you have a digital avatar as a client who walks into this 3D bank branch, goes and taps into a service desk, does the authentication of the company through biometrics, all digitally. And in turn, basically, the agent gets all the data fed about that banking relationship that the client holds with the bank, as well as any offers data that's available through third-party tools like company registries, etc., in markets where it's permissible to get that data offline. So I think all of that will basically help to create a standard set of questions and a standard set of responses that can easily be addressed digitally in a digital bank branch. And for certain complex requirements that clients may have, there's always the medium of level 2, level 3, where you basically get led to a relationship manager or a voice assistant, etc. Lastly, I think such digital bank presence could lead to more financial literacy because it is not bound by real estate challenges, real estate costs, licensing, etc. You can actually leverage the digital infrastructure of future bank branches to impart a lot of financial literacy through training and development and addressing those kind of needs that will eventually help uplift small and medium enterprises. So exciting space to be, and definitely looking forward to my next 20 years being in this space to see how a digital bank branch evolves into.
Yeah, it's an exciting time. There's no doubt about that. But yeah, as always careful what you wish for when it comes to lots of change, but lots of excitement and opportunity ahead. Okay. Just moving on from digital and branches then, I wanted to talk obviously because you're across 15 markets, so cross-border and FX, and FX always fascinates me because when we look at RFI's data and other data sources over the last 20 years, when you look at the reasons that SME owners choose a bank, foreign exchange is never even in the top 10. In fact, it barely makes it into the top 20. It's simply not something traditionally the SMEs have thought about when they're thinking about choosing their bank. However, when we look at friction points and we look at why are you potentially looking to switch, or why have you recently switched, FX is the number one driver of actual switching, not switching intention, but people who actually switched. It's because of FX. And this is an area where the fintechs have played really successfully. In Asia, in the Middle East, in Europe, in the US, it's how Revolut got a foothold in the market. It's where Wise came into play. So foreign exchange, it's traditionally been a lot of customer friction, very slow, high fees, lack of transparency. It's opened the door for the fintech. So a kind of couple of questions around that. How's this going to affect the value propositions of banks going forward? Should they be more FX led? And and how do you take on the challenges as a bank of trying to, when you've got a Revolut or a Wise or any of the other ones that are in the market, and there's some really big ones in South America, talking about the transparency, the speed, the lack of fees. How do you compete with that? So how should banks be thinking about FX, particularly in the SME space, where now when you launch a business, you can launch a business as a solopreneur, I think they call themselves these days, and there's lots of debate about, how many years are we before we have our first unicorn that's got a single founder and employee who's one and the same person. So in a world where you can be global in the same minute that you launch, thanks to e-commerce and cross-border, how do banks consider FX when they're thinking about their onboarding value proposition?
Sure, thanks for that. I think I'll touch upon three themes or rather three aspects in addressing this question, right? So, and again, I'll draw on a lot of personal experience because fintechs are obviously, as you said, providing a lot of good UI, UX, etc. So I'll talk about my own personal experience on using some of these as well. So three themes that I'd touch upon. Number one is, I think, the approach for a lot of banks and financial institutions who have much deeper product suites than some of the fintechs is more client-led than transaction-led, right? So again, now talking about my own example, I'm an avid traveler and I have to travel for work as well. So there are many times when I use some of these fintech platforms in terms of my own personal FX needs, and excellent UI, UX, very user-friendly, very easy to understand kind of interfaces. But the limitation that I see in many of the fintechs offering such kind of platforms is it's very transaction-led, and it's very limited to a transactional experience for me. Where I think banks and financial institutions truly differentiate is going beyond that single FX transaction and waiting for, so to say, the next FX transaction to happen. They go one step beyond that and they try and understand the core need that the client may have, especially in case of SME banks now. You talk about the underlying trade, you talk about why is this transaction happening? And that's where the whole aspect around relationship, understanding the client, offering the right kind of products and services, going beyond simply just an FX transaction and offering what may be more suitable for the client, holistically speaking. I think that's where a client-led approach than a transaction-led approach truly allows banks and financial institutions to differentiate themselves. Number two, I think you touched upon this, and I think transparency and security is something that's coming very organically with the financial institutions and banks across most markets. We're very well regulated as entities, right? Banks and financial institutions, by their very nature, are fairly well regulated across markets, and it's almost an organizational DNA for them to have transparency and security as part of their BAU processes. Treating clients fairly is a part of a regulatory requirement, so it's not even a choice that banks have, and it's almost second nature to make sure that the right kind of pricing, the right kind of transparency in client terms, charges, etc., is made available. Lastly, on this particular aspect, I think some of the continued investments that banks make on security, whether it is robust systems, using the best-in-class kind of fintech platforms available to strengthen those kind of systems, the frameworks around it, the fraud monitoring controls, etc. I think that should instill a lot of confidence in the SME clients on how banks and financial institutions are addressing the risks around cross-border and FX. And lastly, the third theme or third aspect I want to talk about, I think, is a standardized and consistent offering across client segments. So many of the multinational banks, or many banks who are present in multiple segments, can actually and do bring in a lot of the best-in-class experience that they would say offer to a corporate banking client. And those kind of platforms and experiences would very much be available to a small business kind of client. So I think that sort of standardization really helps not just for a bank, but also for an SME to experience what, say, a typical corporate banking client would do. And that's where I think, again, banks have differentiated and continue to differentiate their offerings.
Just coming back to your second point there on transparency and cybersecurity, because you kind of feel like it's not quite a level playing field. If you look at, constantly in the media, you have particularly in the UK, the big fintechs, Mondo, Starling, Tide, Revolut, everywhere. That you're constantly seeing, how well they do on UX, how well they're doing on their growth, how well they're doing on customer acquisition. What gets promoted, probably slightly less in the media, is when you look at their fraud and their cybersecurity and their customer rebate percentages. They're exponential compared to the banks who are pretty good at handling that. So they're really pushing the boundaries on reducing friction, whilst at the same time perhaps not being so great at reducing cybersecurity and fraud. Particularly when you're looking at cross-border, cybersecurity and fraud are huge, never-growing issues. So how given the slightly unlevel playing field and how the big fintechs are playing and frankly getting away with it, how do the banks respond to those meeting SME needs of reducing friction, but at the same time not creating a cybersecurity minefield and fraudulent minefield that's going to create a lot of unhappy customers?
Yeah, so I think for this question, I'd comment more generally on how the space of security, client due diligence, and transaction monitoring has evolved and continues to evolve. And I think what I'll kind of cover will not be very dissimilar to its applicability to the space of cross-border frauds, right? So I'll speak about a couple of themes. So number one, I think the controls that we touched upon earlier, right? So stronger controls, the enhanced governance that banks have in terms of efficient client due diligence, anti-money laundering, the kind of systems that we put up for transaction monitoring. I think that is one big differentiator. Number two, I would think the use of preventive as well as detective monitoring tools and policies, right? And I'll touch upon some examples of how I see that space playing out. But first and foremost, I think the availability of data, and we touched upon it in one of the earlier questions, that's been the biggest differentiator over the last few years, that not only do we have many data sources available, different types of data, and that data is digitally amenable through APIs, etc., but also there is a plethora of tech solutions and fintech platforms who are specializing in using that data and helping banks and financial institutions to build the right kind of controls and monitoring, right? So that's definitely a very welcome change in the last few years. On the preventive monitoring kind of controls, right? So I'll just think about a couple of aspects which would be important in this space. I touched upon best-in-class screening tools. There are databases, watch lists, etc., that support banks in terms of onboarding systems and the CDD platforms or client due diligence. The strong regulatory oversight that I earlier touched upon by the virtue of being a bank, I think it comes as second nature for banks and financial institutions. Monitoring suspicious transactions, reporting them. I think the transactional controls around sanctioned countries, high-risk countries, watch lists, individuals in that kind of a space, whether it's politically exposed or any sort of risks that we see. I think these controls are very, very organic as part of the bank's infrastructure and monitoring. And lastly, on the detection-based kind of a tool, I spoke about preventive earlier, and then you obviously have detective-based. When you talk about detection-based, it's about, I think, the longevity of the goal, right? So given banks are investing heavily and continue to invest heavily in the space of data monitoring and analytics to detect these anomalous sort of trends real time, and also have the right kind of policies to ensure periodic reviews of client profiles, etc., that continued investment and engagement on this theme, I think that has really been a big differentiator and will continue to be a differentiator in ensuring better cybersecurity, better controls, and as I said, doesn't really differ for cross-border risks and how they are being addressed.
Sure. Fantastic. Thank you very much. Rishi, we're out of time. Thank you very much for joining us and for sharing all those hard-earned insights across the not just the Asia Pacific markets, but in the SME banking space in general. That was really helpful and very insightful, and I think all our listeners will enjoy that. So thank you very much for your time.
Thank you so much, Charles. I was happy to do this and very, very insightful for myself as well, with a lot of thoughts coming to my mind while I spoke about some of the responses.
Fantastic. Thanks very much, Rishi.